start recording. So once more, thank you very much for coming over. And I would like to start with asking you, do you have any questions about organization of the class? What is expected from you and things like that? No questions?
Maybe I have a question. It's regarding the final assignment, which we have to submit by end of May. I guess I'm not remember when exactly.
Just give me a second. I'm going to share my screen with you, and from there, so like, you know, for like anybody who might not, you know, so like right now you should be able to see my Moodle page. I hope you do see it. If not, please tell me. So the final assignment is over here, the final paper, you know, in nice capital letters, so it's clear to everybody. You download the brief, which basically tells you like what you should do, and you upload it over here. So what's your question, David?
So my question would be, when is the deadline to submit the...
All right, so basically if you just click over here, and like if you just don't remember, it says, oh, it's check. So it's 10th of June at midnight.
So let's say 1 month. But is it the... so if we will fail from the first term, then we have additional 2 more terms, so we can rewrite this.
Exactly, and like, you know, because like, you know, like basically this term, like you know, it like replaces the exam. You know, basically like all you have to do is really submit this paper, and you'll get your grade. If you fail, you know, basically I'll just make you to rework it. I'll tell you exactly what's wrong, and you'll just rework it, and then you'll get your grade. You'll just have to do it once more. It won't be so difficult because I'll tell you exactly what's wrong, if it makes sense. So, you know, like for example, like, you know, like I know that the feedback I was giving you on your, like, you know, homeworks, like, you know, so that's still like, you know, not really detailed, even though even there I tell you like what you did wrong and what you didn't. So basically I'll just go by question, sub question, and tell you this is wrong and why, and you'll just basically have to rework it. And so, you know, like it's true that, like, you know, that date is kind of like a deep into exam season. I just wanted to give you like plenty of time to do it. But don't be really so afraid, because like, you know, like this like a pandemic, it basically impacted like everybody slightly different, and there's no way how to know how. So, you know, I would like to also use this like opportunity to kind of like make clear to everybody that, you know, if there is a will on your side, you know, I'll basically make everything possible. So like, you know, for example, you know, if you get in a trouble for like for whatever reason, and like, you know, you basically say, hey, like, you know, I didn't get enough of points, but can I do this and this and this? I'll always say yes. All right. So
okay.
I just basically want to make sure that, like, you know, you like, I want you all passed, you know, because, you know, like we need to continue in this strange time. So you know, do your work. If it's not enough, do some more. But, you know, always reach out to me if you have any problem. And
But what's the requirements? Like we have to get 60 or 70 to pass this course?
together, yeah, like so just it's a good thing that you ask, you know, even though I sent you the information before, but it's fun. It's really, you know, it's we need to talk about it here because we didn't see each other for quite a while. Just give me a second. I'm just trying to work out Zoom. How do I unshare the document if I want to share another one? It's so silly. Sorry. You still see my Moodle, right?
Yeah.
This is pretty. Apologies, I still can't figure out how to actually do it.
To share?
Well, to share a different screen.
Where's the on top? If you go up with the mouse, there is a sharing, so you have to change from
yeah,
one to.
but like right now, I don't even see the zoom. That's the problem.
Yeah, but if you go up, it's on the
Oh
screen.
yeah, thank you. Perfect. Yes, it's very good. Yeah. So yeah. So I'll just share. Share. So now you should be able to see the syllabus, the updated one. So basically, these are the requirements. So weekly assignments, that's your homework, that's 20%. So like, vast majority of you is completing them. So it's basically like, like it's a lot of work, I understand, but that's 20% of your grade up from there. And then there is a final assignment, which is 80%. And that's basically what we just talked about. It's that one paper which you have to write. And I'll go through the I'll go through the brief now quickly as well. So I'll tell you like exactly how to do it. And then to pass the grade, you have to get 60%, at very least 60% of all the possible points. So like because the homework is 20 and the assignment is 80, then like you basically have to collect 60 points at the very minimum. Also, as last semester, I'll be really receptive, and like if you just get 3 and you say, hey, I want 2 or 1, I'll also like make that possible as far as as long as like we don't run out of time. So that's good. To the assignment itself. So just give me a second. I'm just going to download it. Just going to download the brief. Right, stop sharing. Yeah, I'll just do it this way. So, and now you'll just basically, so now you should be able to see the brief, and I hope, you all saw it already, or like, if not, just like look through it so you understand what is expected from you. So basically these are the questions which you need to complete. There's how many questions? There's to do 5 questions. They should total at 50, at 80, maybe at 100. In that case, I'll just like recalculate it, but that's easy enough. So first, there's a word limit. It's basically the maximum amount of words which you can use. Numbers don't count. Obviously, because it's mostly calculations, you don't need to use you don't need to use all of them. If you write 2,000 words, that's perfectly fine. Just like, I like that word limit is there. So you basically just don't write like 10,000 words or something, which, it's basically to protect me because, even though like you might do like excellent work, of course, like our time is limited as well. Preferred format, basically, the best way is basically to do all the calculations in Excel, and then basically, but then put everything in a Word or PDF, and basically just like kind of like explain what has been done, interpret the results, and also like answer the theoretical questions, which are the last ones. So the first question, also like what's important, very important, is this MN over here, which is basically a number derived from your name. You always see that there's a data. So like there's one data set, like variable X and variable Y, and there's always like this MN over here, which you have to add to it, and as the abbreviation kind of suggests, it's derived from your name, and the instructions for it are here at the end. There's a guidance how to calculate your MN. So you basically take your first name and your second name, and you basically find, so like if your name is Anida Brood, so it's 1 and 2 together, it's 3. So that's that's basically your MN. There's like few examples over here. If your name is Mahatma Gandhi, and then it would be M, so that's 13. And for G, there is 7. So MN would be 20. If your name is Jack Sparrow, to find a famous pirate, it would be 10 for J and 19 for S. So your MN would be 29. Any questions about that?
So it's the sum of the
sum of the, yeah. So basically you just use your first name and your second name, and you sum them up. If you have like a kind of a thing which I didn't really consider, you know, in a case you have more than 2 names, you basically just use your first name, the first name. If you write down your name, you know, you basically use the first name, the very first, and the very last. All right.
Yep.
So basically that's just like to make sure that everybody has a slightly different data. So the first question, you know, it's a simple linear regression. So you know, you basically just have to calculate the regression. Then like, you know, there's some like few application numbers connected to it. Then the second question, it's also a regression. This time it's with the dummy variable, so we have exercise on it. I trust it, like, you know, I think that all of you actually submitted the homework on dummy variables. So you basically just use dummy variables for the type, and this like is basically the second variable. So it's basically the same calculation as you did with the Volkswagen Golfs. You know, when you were trying to figure out which one is cheapest and which one is you know, most expensive. So it's basically the same kind of calculation. The third one, you know, that's I don't believe that you actually did, like, some of you already did the homework, some of you didn't, because I think it's due on 15th of this month. And so it's basically a forecasting method, again using regression. This fourth question, you already did the homework. That's for the, you know, that's for the portfolio optimization. But be really careful with this question, because there's 3 assets. There's stocks, bonds, and commodities. And if you look at the lecture slides, you know, in the third unit, if you look at the lecture slides, you find out that the variance is calculated slightly differently for 3 case. Okay, for 3 case portfolio or 3 asset portfolio. So be careful about that. There's going to be more combinations than like what we've seen before, and it's going to be 66 possible combinations. And just make sure that you use the correct formula to calculate the variance. And then there's a theoretical question which is worth a lot of points, 30, and that basically, like, you know, it's a theoretical question about black swan events. You have to do a little bit more research, because even in lectures, this is actually not really so much covered, except of like when we talked about the probability distributions and how likely like these like rare events are. You know, you somehow you know, that then, like, you know, it kind of like applies to it, but like you have to do your own independent research into this question. Basically, just research black swan events. COVID-19, you know, pandemic. You just look at what's happening in the financial markets right now. That's also kind of unexpected. So doesn't have to be. Sometimes people say that it's not really a black swan event, but you can categorize it that way. So you might also write about that. Any questions about the final assignment?
Yes, I would like to ask. I joined a bit later. Sorry for that. Where can I find this document? On Moodle then?
On Moodle, yeah. So just give me a second. Sorry, I have to go over here.
I'm gonna be honest. I didn't start it yet. So
it's fine.
The deadline was in somewhere like mid-June, right? 12th, I think.
Yeah, like 10th.
10th, okay.
Yeah.
Sorry for interrupting again.
It's all right. It's all right. You just go to Moodle. You know, this final section over here, final paper important. There's a brief for you, and here you upload it. So here, you know, I know it might appear to you in Czech. I don't know how well the language. Actually, I should probably change it over here. Yeah, that's okay. So Wednesday, 10th of June. I should probably change it to, give me a second, so I don't forget. Edit settings. I should change the due date, and what we'll do is I'll change it. So like, because sometimes it happens that it like requires you from in the morning. So it's 10th of June, just before midnight, 1 minute before midnight. That's the deadline. All right.
Okay. Are you gonna have well, perhaps online or normal office hours? Somewhere, what is it, 10th? So you have it Tuesdays, I believe.
Yeah, I'm going to open Zoom office hours. They're going to be kind of random, so I'll just always send you a link and say, hey, can you join in this time? But I don't know, anybody of you who contacted me through email, I hope you can agree that I've been really responsive, and I will do the same thing. So what you can do is even request personal consulting hours with me, and I'll always grant the wish, so you can basically just ask me for for a few minutes of my time, and I'll always give it to you. But yeah, I'll hold some consulting hours during the exam season as well.
Okay.
They're going to be kind of random though, I'll always a few days in advance. I'll basically send you an email saying, hey, Zoom consulting hours are happening at this time.
Perfect. By the way, can I ask you, do you know about the final state exams? I've heard they're going to be taking place at Metropolitní.
Yeah.
However, what about the other students that are outside of the country,
I have no idea, honestly. I'm sorry. I've got a notice that I have to come to school a few times for the exams. But for students who have to finish their studies, and they are already somewhere else, I have no idea what kind of accommodation the school is right now granting. It's probably a question for studying department. So I'm sorry, I won't be able to help you here, but
that's okay. That's okay. Thank you.
All right. Any more questions? Is the homework difficult?
Final assignments for sure is more difficult than the homeworks.
That's just because you have to figure out which method you have to use. But I kind of did it the way that. Sorry, this is not the right document. So all of the things are actually basically a repetition of the model of the calculations which we did. So again, this is a linear regression. This is a linear regression with dummy variables. You can use quadratic regression if you want to. This is a forecasting, which is the homework 5. It's basically kind of a replication of it, nothing else. This is the portfolio optimization, and that's pretty much it. Yeah, so everything which is in the assignment was done in the homeworks except of the theoretical question, which you have to kind of it's an essay which you have to kind of work on independently. But the calculations, there definitely shouldn't be anything which would surprise you. Maybe in this question about the portfolio optimization, just make really sure that you use the correct portfolio, variance formula. So it's correct. Anyway, basically what I want to do today, in the remaining about 50 minutes, I just want to we didn't do lectures this semester. I basically gave you everything on Moodle. I hope it was sufficient. Was it difficult to kind of work through the lecture, work through the YouTube videos, and kind of do the homework? Was it do you feel like you need more information? That's the question.
No, I think that the video covers everything already.
Yeah, all right. And anyway, I gave you this lectures. So, really quickly, I'm just going to kind of go through them. So I kind of pinpoint a few things which are important. And, just so you guys are a little bit like you have like a little bit better picture of like what's required, and like I understand that might have been a little bit difficult to do the homework without the lectures before them, but like that's why we are now like we are going to catch up a little bit more. So let's get started. I hope you now see the lecture slides.
Yes.
Perfect. So first, quickly, we'll talk about the correlation analysis, all the regressions. Then we'll talk about the portfolio optimization. And then the last thing which we'll talk about is going to be like a really short lecture about how to use regressions for forecasting. So correlation analysis. Sometimes people kind of like confuse like correlation analysis with regressions. It's basically like, almost the same thing. Correlation analysis is basically, a correlation is a relationship between two variables. Regression is a method how to calculate that relationship. So if you hear correlation or regression, they are basically the same thing. One is a method, the second one is a relationship. So you probably heard about correlations. You even calculated some in your homework, and now, like after you completed that third homework, you are basically like perfectly capable of calculating homework, like regressions fairly quickly. I always recommend to use that data analysis tool which Excel has, because it just makes everything much easier. And but also like you can just basically figure out from the chart if it's a relationship just between two variables. So well, correlation, it's basically the most important thing you will ever learn in statistics. It's kind of like because like things are becoming a little bit more mathy even in business. You like sometimes like even now here like people kind of talking about like that something correlates with something. It's kind of became a little bit trendy to talk about correlations. But like most people kind of do it kind of stupidly. They just like basically say, hey, there's a correlation, even though they have no clue if there actually is one or not. Or like there is just because there's a correlation doesn't actually mean absolutely anything, and we'll talk about it now. So what do we use correlations for? Basically, you have to like realize that everything with everything correlates in the world. Like there's like it's actually more difficult to find out things which are totally independent from each other. So in finance, this is a financial class. So in finance, like the analysts, they usually take stock prices and they're trying to figure out how does it correlate with balance sheet, income statements, with any of the ratios which we use in corporate finance. Rating agencies, they basically like look all of the like macroeconomic like data, just like the indebtedness, the GDP levels, the amount of external debt, and from that they calculate the likelihood of default of a country or a company. Real estate analysts, they correlate the number of visitors to shopping centers, for example. They basically like there's a strong correlation between how many people go around a shop and how profitable that shop is, and that translates into how expensive that shopping center or that shop is. There's like really a lot of possible things of like what the correlation can be used for, because it's basically a very handy method of like finding relationships between, or like finding relationship between two or more variables, even though it gets kind of messy later on. So this is like basically the easiest example of a correlation. This is an example of a simple linear regression. So basically you have observations. There's about, I don't know, 10 of them. And you basically fit a line in between them. In this case, it's a simple correlation which like like some shop was basically trying to figure out how sales correlated with advertising, how much was spent on advertising. So you basically just like plot it in this chart. You find that there's a relationship. You fit the line in between. It's optimization. Regression is optimization method. You basically trying to find a line which has the smallest differences between them, and it's done with the least square method. So so you just fit the line. You can express it with equation, and that equation is really handy, because then you find out, hey, if I spend this much more on advertising, I'll get this much more sales, and like, you can figure out like, what's the optimal strategy for you. So but it gets actually quite messy, because correlation is of course only indicative of causality. Never kind of like I say, just because something correlates with something, it means that there is a causal relationship. It's much more difficult than that. This class don't even get that far to actually calculate how much causality there is. You may always talk about expectations, but not like, never actually say with absolute certainty that there is a causality. If you get a really strong correlation, what you get is a probability that some kind of relationship between the variables, the factors which you used in your correlation, that exists. You don't know how it works, but there is a relationship. But it might be the causality might go one way, another way, can go both ways. There might be a multiplication effect. There might be omitted variable in there, or and that's the worst, it might be totally coincidental. But that coincidental part, we can actually calculate the probability of it at very least. So, for example, if I look once more at this chart over here, at advertising dollars and sales, basically, what happened was that, of course, this was measured in a time, in a time frame, and the observations were made. What you don't know, for example, in this situation, is what happened in the meantime. Maybe, and you don't really know that, maybe the tide, especially if if these observations went along one timeline, maybe the sales would increase even without the advertising increase. You just don't know that, because maybe the company just became more popular on its own, and this correlation might be totally spurious, might be totally coincidental. Just because you point this chart over here, it doesn't mean absolutely anything, and the uncertainty is always there. But it's better than nothing. It's better than nothing. So what kind of relationship we have? We have positive relationship, which basically just goes, one variable increases, the second one increases as well. Negative, one increases, second decreases, and no relationship. It's basically, you might see that, for example, in this case, if you are college educated, you are not more likely to be own a dog, for example. So this relationship is of course absolutely coincident, absolutely it's not existent. Even though you can fit the line, if you actually saw the mathematical properties of the regressions, that means the R square and the p-values, you would see that there's basically no relationship to speak about. And then, there's a few, quite a lot of information how to actually calculate stuff. We have it in the homework, so I'm just going to skip through it really quickly. Correlation coefficient, you calculate it by covariance and divided by the multiplications of the variances of both variables which you use in the regression. Then the next step is calculation of the coefficient of determination, which is basically the correlation coefficient squared. So R square is the coefficient of determination. That's a really important measure, because it basically tells you how much of of the location of all the points is determined by the other factor which you use in your regression. So if the R square is 0.8, it means that you basically manage to explain 80% of the variance and the locations of individual points. And then you have the remaining part, which is 0.2s or 20%. That's basically the unexplained part. And you basically might wonder, hey, there must be something else kind of playing in that relationship, and you might try to decrease it by adding variables. So linear regression, that's the simplest one. You basically just fit a straight line, straight line between two variables. That's basically the thing which we talked about a few minutes ago. But that's of course it's really elegant. It's easy to use. It's fairly easy to calculate. Not many things in the world are actually linear. The world is messy. Some things you can kind of explain with linear lines, but not really so many. So always in regressions we talk about linear, like a regression model and a regression equation. They are basically absolutely the same. The model always includes the unexplained part, which is the error over here. This is the part you can see that like this part is the same as over here. So model basically tries to explain everything. The regression equation basically describes only the explained part. So that doesn't, you kind of like, if you calculate the regression, you always calculate only this bit. You kind of ignore the error. The error is the unexplained part of the regression. And just like so you understand what the error is. Again, coming to that original regression we had, there is the line over here, and then you have these like little bits. You can see that not all the points, like none of the points actually are on the line. There's always a little difference, and that's the error. That's actually like the unexplained error. That's the part which is the unexplained error. And like sometimes these things, they are called residuals, and we always look at the residual charts and like trying to like when we optimize regressions, and it's kind of getting a little bit more complex. This is basically just guidance of how to calculate it. We did it in Excel, so we don't have to spend too much time on it in Excel. If you want to calculate the slope of the regression, that's the slope. If you want to calculate the intercept of the regression, that's the intercept function. And then there's some guidance on how to deal outliers, but yeah, we will not actually have to do it, and you'll have to not do it in the assignment. Then later there's some guidance about how to deal with the errors. So we have a total error, explained error, and unexplained residual error. There should be a chart over here, perfect, which basically shows you, how to calculate it. So the total error, basically like for any variable, you put there the middle line. So this is the average, of all of the observations on this axis. So it's the average, and then you calculate the errors, in between. Like from that line to each individual point. So for example, this is the explained error because like, this line actually explained this much of the position of the point, but doesn't explain this red part, and that's the unexplained error. You will actually not use these errors for anything. You should just know that they exist. What you will use or might use is really the unexplained error part, which is basically the difference between the line and the observation itself. This part, like in regressions, you use them because the regression to be calculated correctly, these differences basically are like around this line. So from this line to here, and from the line here, and from the line here, this one, for example, doesn't have any error. So they should be normally distributed around the line. If they are not, you know that you did something wrong. So there's just calculations how to calculate each of the errors. You don't usually use it nowadays because like you should understand how it works, but like Excel or any other statistical software actually does it for you. So they are not really so needed. Yeah, so simple linear regression is a great one because you basically just use two things to kind of like find a relationship between. But there's much more to other there's much more what you can do. For example, like even if you find two like factors, two variables which have really strong relationship between themselves, you always find out that there's a part of the relationship is always unexplained. There's something else which is kind of like creating that error. That's the reason why like all the observations are not on that one line which we looked at. So what you should do in this situation is to kind of put another thing in your regression, another variable, another factor, and you might you might increase, the value of your, the explaining value of your regression. Again, like all of you, or like majority of you, did the homework on the multiple regression. So we had, like, in the video, which, I was calculating that relationship between like the price of the computers and, like three somehow separate factors which influence. So that was the like screen resolution, there was the RAM, and the processor speed, the speed of the processor. And you could see there, like, that, like, of course, like if I included only the price at, let's say, the speed of the processor, it would also, like, kind of like create quite a strong correlation on its own. But if I included RAM there as well, and if I included the screen, the screen quality, it increased the explaining. It increases the explaining quality of the regression. So it's exactly what it is. Like you basically just always like want to include more factor than 1, 2 in your regression, so it has a little bit better explaining quality. And that same thing doesn't, like, I know that the example which we did in the homework wasn't really financy. I just want you to, like, kind of like see the value of actually doing it, because, like, if you actually buy a computer, or if you buy a car, you might actually do something like that, because it's a, it's much better than any gut feeling. You basically just collect data, you figure out, you basically scrape the data from the web, and you figure out which computer is the best deal. Or with the cars, it works exactly the same way, or anything really. So, but, like, in finance, like, that's exactly what the rating agencies do. They basically just take, like, this country, this company, or this company, how likely is it to default? So they basically take, like, many things from their balance sheets, and they basically calculate the regression, which gives them the probability of a default. So, this is basically how it's formalized. These equations, they kind of sometimes look crazy and kind of complicated, but they are actually really simple. So on one side, you have always the factor which you want to explain. So in our homework, it was the price of the computer was Y. And then you had the other factors. So, the X1 was the processor speed, X2 was the RAM, and X3 was the the screen resolution. And then, like, after you calculate the regression, you get these, like, B0, B1, B2 coefficients. So B0 is basically like, the intersect. If all of these things were 0, which of course with computers doesn't really work, what would be the price? It would be basically the price of the shipping, or like price of, like, getting the computer to the shop, the fixed cost of delivering a computer. And then, like, these coefficients, they basically give you the the impact of increasing that factor. So for example, if the processor speeds increases by 1 gigahertz, what would be the price of the change? That's basically what B1 would tell you. So, like, it's always the change per 1 unit of, like, depending on what unit you measure. So if it's a gigahertz, then, like, B1 is basically change of the price per 1 gigahertz. And then, of course, like, the model is exactly the same thing with, again, the error unexplained part of the regression added to it. Linear regressions or simple regressions are great because you can always put them in a chart. With multiple regressions, we have only 3-dimensional space, so it's kind of difficult. So if you have one independent variable and 2 dependent variables, 2 independent variables and 1 dependent variable, that means 1 y and 2 x's, you can still express it at least, like, in 3-dimensional chart. If you have more than 3 independent variables, then you can't really express it in a chart. There's no possibility, and it's not possible in 3-dimensional space. So in that case, you just start looking at numbers, and the regressions, like, they don't have, like, such a, like, a great, like, quality of, like, informing you, unless you actually, like, look at the numbers and you know how to do it. So like, simple regressions are better for, like, informing the public on getting idea how something works. But unfortunately, that's not what you really do in academia or business anymore. You need more than two variables which you're trying to explain. So this is just a process of how to calculate it. Now, you might have noticed that when you calculated the regressions, it always shows you the residual charts. And this residual chart, the way how to look at it, it's actually fairly simple. If I go back to this chart over here, the residuals are always, the differences between the line and the dot itself. So you basically kind of like take these, you basically just take these little red differences between the line and the dot, and you express them in the chart itself. So it basically removes the effect of this line over here. That's what the residual chart is, and that's what we are looking on here right now. So basically, there was a relationship, but it was removed. So now, basically these numbers, they should just escalate around zero. Some of them should be above zero. Some of them should be below zero. And what is really important is they should be normally and randomly distributed. If you see that, like, if you have a model which basically doesn't show you, which shows you some kind of pattern in this chart, and the chart is calculated by Excel for you or any other software, if you see a pattern, there's something wrong and you have to change your model. So there's a few examples of what can go wrong. So the residual chart might look like this, and this is called idioscarcity, but you don't actually need to know that. It's basically increasing pattern over here, and when you see something like that, that basically means that the two variables, if you have two independent variables, they somehow interact between themselves, and you usually have to look for multiplications of them, for example. If you see chart like this, what it usually means is that there is something that the model shouldn't be linear. That there shouldn't be a line, straight line fitted in there. You should look for quadratic or some advanced versions of regression. If you look something like that, so a residual chart like that, then that there is that there's something again wrong, and usually what it is either you missed a variable, or the distribution of one variable shouldn't be linear, which should be probably logarithmical in this sense, in this case. And this residual chart over here, again, you can see that they go up, down, up, down, up, down, even though they look random, because there's a time element to it. There's a clear seasonality in there, and you have to include the seasonability. Dummy variables are great because sometimes you deal with categorical data. Again, referring to the homework we did, we had real estate prices, if I remember correctly, and they were happening in different different locations, or no, there was about or types of houses. Basically, for any category, you can always use a dummy variable where you basically just replace one. For any two categories, you always assign 0 and 1 to in a regression, and basically starts working that way. It can be used even for regressions which or for categories which have more than two possibilities. For example, I don't know, pregnant, not pregnant. It's not probably the best example, sorry for that, but or company goes bankrupt, doesn't bankrupt. For example, you always assign 0 and 1 to each of the categories, and you can do it either way. It's totally random. The equation comes out slightly differently. You should just know that you get the coefficient for the variable which you used, or for the category which you used one for, and the effect of the other one is basically absorbed in the intercept of the regression. I hope that was kind of clear from the tutorial for the variables. If you have more than two categories, you basically have to create dummy variables for each of them except of one, which always have to be included in the variable. So like, in forecasting, in the fifth homework, we use dummy variables for seasonality, for quarters. And because there's 4 quarters in a year, so then you use 3 dummy variables. And the fourth one is always included in the is always included in the in the intercept. Yeah, so like there's more examples of how to use dummy variables. I'm just going to skip through it because we want to get to some other things as well. Building a regression model, well, that is kind of a complicated one. I'm just going to kind of like do it, on an example probably, because that's going to be slightly better. Maybe here in the linear regression. So like this is the this is the exercise which you all did. Basically, if you're building a regression model, this one is quite clearly correct. You basically have 93 r square equal to 93. I hope everybody now sees the Excel. So if I'm just going to into option, this is really like a handy way how to actually do it in Excel. Usually you just have to kind of it's like a trial and error kind of a process. So first of all, if I see a regression like this, I already see, kind of like intuitively that the residuals are kind of like all right. They are like nicely distributed around. But let's say, that it actually looks slightly different. Let's say that, what to do. I apologize. I have to go for a second, just for a minute. So I'll be back in a second. Okay. Thank you very much. Stay online. Takže děkuji moc za to všechno. Potřebujeme fakturu, jak to se domluvili. Nepovednou byste říkali, ale nepovednou byste to vyšli tady. Děkuji moc, ta podlaha vypadá skvěle, si myslím. Jako... Tak jo, tak se někdy. Tak jo, já jdu účastnit se sám přes vlastní konferenci. Takže někdo se aspoň. Apologies, I'm back. So I just wanted to kind of change the numbers over here. So if I saw something like this, sorry, my mouse doesn't work anymore. Plot area options. Perfect. So, for example, I'm just basically looking at the R square over here, and I'm trying to like get it as high as possible. So like I might try logarithmical. It was perfect. Thank you very much. Where do I have any zeros? That's not what's supposed to happen. What the? Not the best day. Polynomial. So for example, I have to include the numbers over here. So, you might see if I go linear, it's 92. If I go polynomial, it usually goes up a little bit, but that effect, for example, in this case, is quite weak. So I might not get actually significance of it. That's another thing we shall talk about in a few minutes. But like you see that, like the R square over here kind of increased just because I changed the shape of the equation, that changed the shape of the line, and basically added a quadratic concept to it. For some reason, it just doesn't let me to do the logarithmical right now. It's basically because of the shape of the data, probably. So that's basically like what you're trying to do. You're basically trying to find a relationship which fits the best. That's which explains. So basically, I moved from like a 92% of that first line explained 92% of the observations, and like the second line like explained over 93%. So it was like 1% of increase. So it's the optimization process. You use the residual charts doing it quite a lot, because they basically tell you what kind of a they are a really good indication of what kind of a equation would fit. So like for example, this would be like the quadratic quadratic relationship. Over here, I would this one we see quite a lot in clinical trials. For example, when they change, when they using combination of vaccines on patients, and there's a increasing tendencies of when you use more than one vaccine. So you usually get something like that, and you kind of have to change the equation. So there's this increasing effect is used. So, for example, you would do this in the equation. It gets really complicated, but I will not want you to actually do anything like that in the assignment. Building regression model, so how do you actually calculate, if you want to calculate the more complicated regressions? Well, it's really easy. Basically, you take it. Let's say you have an equation like this. How do you calculate it? So you basically first in Excel you have to x x1 and x2, let's say, nothing else. Then you basically just recalculate the x1 to x1 squared, and the x2 you basically just calculate separately logarithms of all the observations, and then with at least a transformed variables, you basically just calculate a normal linear regression multiple one. And so basically in any calculation, you don't do all of the steps at once. You basically first recalculate the variables into the transform state. In this case it was logarithm, in this case it was squared, and then you basically just apply the linear regression model as if it was easy enough. But again, I will actually not want you to do that, but you can I think in one of the quite a few of you actually already did that in the in the homework with the multiple regression and with the dummies. Quite few of you already tried the the quadratic variation of the regression, so you already know actually how to do this. Last thing in this lecture, before we start next lecture, is testing for significance in regression models. That's something to do with the hypothesis testing, which we didn't cover in this class, but I'm pretty sure you already know what it is. It's basically with everything, in regressions, usually what you have is sample data. So you actually don't know if it's a representative of the population, and you basically just have to find out the probabilities of what your conclusions being correct. So like I'll just go like at the very end, just so you can kind of like see like, you know, how do you actually do it. So, you know, you basically use two tests in regression. So you use the t-test and f-test. You know, both of them basically deal with the same the same logic. You know, always you have there the h0, which is so-called null hypothesis, and you know, null hypothesis in statistics or anywhere else is that the relationship doesn't exist. That, like, you know, basically, you know, the whole world is anarchy. It's a entropy. Like nothing exists. Nothing is caused by anything. That's a null hypothesis in all of the like statistical testings, and you basically trying to disprove that. And you do it by using p-values or the f-values in regressions. So, and like, you know, again, like, you know, I will actually not want you to run the charts or like run the tests themselves, because Excel is handy and does it for you. And that's how we do nowadays the statistical analysis. You should know how to, what it means, but like, you know, actually calculate p-values is a total waste of time for anybody. So, so in the analysis 2-pack, what do you usually get, you know, when you run a regression? You know, so this is the example of from the homework 3, you know, the multiple regression, which we calculated the relationships between the relationship between price of the computer and the relation and the resolution, processor frequency, and RAM. So, you know, you might remember that the R square, it was 57. You know, it was based on 373 computers, and then you get, like in this table, you get the coefficients, which is basically the impact of like, you know, of like you know, always like increasing resolution, processor frequency by 1, and what effect it will have on the final price. So for example, if you know, increase the processor frequency by 1 gigahertz, it will increase the price of the computer by just over $400. Well, you know, 1 gigahertz of frequency on a computer is kind of a big step. So that's why if you increase RAM by 1 gig, it goes up by $50. You know, so all of these are the effects of the, you know, of you know, and like you basically rewrite these in the equation. So like, you know, it's a y equals minus 861 plus 0.62 times x1 times 413 times x2 and so on. But then you have to look at like these data over here, which are extremely important. So the p-value, you know, it basically tells you the probability that the relationship does not exist. That's what the p-value is, at least based on the sample data which we have. The sample which we use was kind of like a nice one, so the probability is really low, and we can actually, in such a big samples, it's quite easy to find relationships. You know, you can see over here, you know, that the probability for resolution not having actually any influence on the price is 0.0000 many zeros 16. So it's very low probability that letter resolution doesn't actually have any influence on the price. Usually, what we do is we look at the you know, we basically set a probability level which we are okay with. Usually use 90% certainty, 95% certainty, 99% certainty, and sometimes you can even use 99.9% of certainty. And it's basically a reverse number to this. So you basically take the p-value minus that, and that's your certainty. You know, so for example, like, you know, Excel can do only 13 zeros. I didn't display them here all. So, you know, but you can see that if I take 1 minus this number, or even this number, I'm still at a higher number than is 99.9%. So my certainty of that this relationship exists is higher than 99.9%. The same thing goes for the f-test, which is the overall significance. Basically, these, like, you know, are like probabilities for each of the factors which we include in our regression. If we look in here, that basically gives us an overall significance for the whole regression, which, you know, it basically always has to be bigger the f, which we calculate, has to be bigger than the significance of f. Our significance of f is very small. Our f is way bigger. So, this relationship is really significant. And then, we always look at the R square, which is 57 in this case, 0.57, which means that our regression explained 57% of the price. The remaining 43% are unexplained, which basically means that if I look at a random sample of around 400 computers, about 57% of their price of each individual one will be determined by these three factors. The other ones, well, we still have quite a lot of factors which you have considered with computers, right? Like, there's a brand, there's like perceived reliability or real reliability. There's, designer value, for example, things which are kind of like more difficult to include in a regression. And that's why, and that's based on a real sample. It was basically a data scraped from Amazon. And so you basically see that you manage to explain 53% of the overall distribution of the price, but there's still 43% of unexplained factors. So that's basically how we interpret the regression. Any questions? No? No questions? So I'll go to the mean variance. So we have a little bit better idea of what I want you to do in the portfolio optimization methods. It kind of continues with what we did last semester. Some of you, majority of you actually had the financial and capital markets with me last semester. So this kind of continues on what we learned when we talked about the portfolio optimization. How do you do it? So can anybody tell me the concepts of diversification of what is important to consider when you are diversifying a portfolio? Guys, still there?
Portfolio should be diversified because of due to the risk that carries any kind of investment or.
Mm-hmm. Yeah, perfectly. Yeah, you basically just you have to kind of spread it out. So if one investment fails, the company you own a share of goes bankrupt, you get nothing. So diversification spreads the risk. It's really important. But we also talk about one important concept, which you into diversification, and I just wonder if you remember it. Basically, what we talked about was that you don't want just spread out your investment. You also want to find investments which are kind of they are not they don't have the same probability of failing. So for example, for example, 3 months ago, if you invested in US Airlines and Delta, which are both airlines, if you invested in these two companies, well, you probably don't have too much money right now, right? Because the likelihood that one airline goes down with COVID pandemic, is very high, and the second one is exposed to the same risk as well, right? So, what you do in portfolio optimization actually is you are trying to figure out which investments are not exposed to the same risks. And it's obviously a very difficult thing to do, but let's just again go to the original example. If, for example, you invested in Delta Airlines a few months ago, but at the same time you invested in a Tesco grocery stores, you would be probably still feeling a pain right now, but you would be much better than if you just invested in different airlines, right? Because the grocery shops are much less, they are basically exposed to a totally different risks than the airlines are. And then something unexpected happens, for example, COVID pandemic, and the Tesco is actually prospering quite a lot because they have a really very good food deliveries or like, grocery deliveries. Some of them might have even used them in Czech Republic while nobody is flying now. So basically, that's what we do in a portfolio optimization strategies. You're basically trying to find ways which are like find investments which have kind of like which are displaying a different thing than like during the business cycle. Of course, like COVID-19 is kind of like unexpected thing, and if we don't actually have like a good a precedence for it, only from times which like stock markets didn't actually exist yet. So basically what you do in portfolio management, you are like first looking for things which have different volatilities over a business over a business market, business cycle, sorry. But also you are looking for as low correlations between assets as possible. You always want your investments to kind of grow over time. So finding a negative correlations between assets is impossible, because like you can't find a negative correlation between two growing lines. But you might find correlations which are really low. That means like, you might find stocks which are growing in different periods of time. And the best example of this concept is like stock and bonds, but also, for example, stock and gold, for example. So, gold, basically every time there's a huge recession, people panic, they start buying gold. And that's why gold as a commodity always goes up during recessions. And while stock market is usually doing very badly. Right now, like what we see on the stock market is kind of like unusual because the markets kind of expect a big monetary boost. So like the stock market, even though 2 months ago it was doing absolutely terribly, it went down by about 20%. But since then it was growing kind of solidly. And it's because like it's kind of a weird thing because there's like a huge recession now coming, but at the same time the stock markets are not really feeling it. But usually that's exactly what it works, how it works. When stocks go down, gold goes up, bonds also usually go up. Some of the currencies also go up, like for example, Japanese yen or Swiss franc. Usually, these things are usually go up. So what you do is find these like pairs of portfolio of assets which have like a different like they are acting a little bit differently, and you basically put them together, and then you basically follow like calculate how risky they are in a combination. And because there is only always like between any two assets, there is always like a limited correlation between them. The risk is kind of like it's always like if you combine the two assets, the risk is always lower than if you just used like one asset. But if the correlation is low, it's substantially lower, and that's the whole point. And so, for example, like basically what you do there is you need to have a proxy for risk, for like how risky the investment is. And what we use in finance is it's a standard deviation of the asset price. Basically how jerky, how unstable a price of anything is, how much it goes up and down. You basically just use it as a proxy for riskiness. Again, like with things which are like really like a business cycle dependent. It usually goes up and down quite a lot. I don't know, like a great example of stocks which are kind of like like really cycle dependent. For example, real estate developers. During recessions, nobody's buying houses. That means they have no revenue. When there's expansion, usually housing prices go up. A lot of people are buying houses. Developers have a lot of revenue. So the prices which are based on real estate are usually extremely volatile, and they have a high portfolio standard portfolio of the price of their stock. So how do you actually use it? Well, you basically calculate the average return, over some period of time in the past, and the standard deviation, which is our proxy for risk. and then you basically just starting, then you just basically calculate like, a risk for all of them. And so what you do is, you basically just like, this is an example where I'm using combination of stock and bonds, which is exactly the same example which we used in our homework. I basically just like take the, bonds on its own have this much of a standard deviation, but then if I add highly like volatile stocks to it, you can find out that the riskiness of the overall portfolio actually goes down because the standard deviation goes down. At the same time, the average return goes up. And then, the trend reverses because the stocks, after all, they have a lot of variation. They have like they are kind of unstable. So then it starts increasing again. But you can even over here, you can still see that like, with like, about 40% of stock including the portfolio, the overall riskiness of the portfolio is still only as high as if I just use bonds. Because and we talked about it last semester. If you own only bonds, like if you own, for example, if you own U.S. government bonds, for example, it's a stable and safe investment, right? But for example, if you want to sell it before the maturity, the price is still determined by factors like interest rate and like how much money there is in circulation. So you are still kind of like uncertain of like how much money you will actually get from it. So there's still volatility associated with bonds. And if I add some stocks to the portfolio, this volatility decreases quite a lot. So this is what the what the calculation you did in a homework is about. And the very last thing which I'm going to tell you about, I'm just going to skip all the way to the end. So, these are the formulas which we used in the homework. This is for the 2-case scenario. In the final assignment, you have a slightly different thing. You have a 3-asset portfolio, and you need to use these formulas. Otherwise, everything is just going to do, which you're going to do is going to be wrong. So make sure that you look into this lecture. It's the very last slide, slide 17, and you use this formula over here. It looks really complicated, but really like what you do there is the weight. We basically use the the standard deviations of individual assets times their weight, and then you have like for each combination of the 2 assets, so asset 1, asset 2, asset 2, asset 1, asset 3, asset 2, asset 3, you basically include the intercorrelations between them. That's the pi over here. It's the intercorrelation between them. So make sure you use this formula when you calculate the question in the assignment. Any questions?
Nope.
Okay, perfect. So in that case, thank you very much for coming by. I just want to ask you, like, next week, do you want to have another lecture? We still didn't cover the time series, and like there's not so much talk about there. There is only like there's like a few various like time series things, but like in the final assignment, I'll just want you to use the dummies. So like most of the lecture is actually not relevant to the assignment so much. Only the seasonality kind of is. So I just kind of like wonder if you like would appreciate any lecture or not.
I personally would.
Yeah. All right. So let's do it. So probably next.
If other people won't be able, to attend, so. But
yeah, that's true. Anyway, like the attendance again, like your situations are like all over the place. Like some of you are out of the country, some of you don't have a reliable internet. The attendance in these lectures is totally voluntary. So like you might come, you don't have to. I'll just do one more lecture, a short one next week, and like we'll probably talk about the assignment some more. So like you kind of like know what to do, and just like it's just before the exam season starts, so I can give you like a little bit better like informations about what expected from you. But like I think that because we effectively canceled the lesson, so you'll just get more points from the assignment. So you just do the assignment well, which you shouldn't really have a problem to do if you did your homework, and you're fine. All right. So once more, thank you very much for attending. And I'll see you next week.
Yeah, okay.
Thank you.
By mail, please, by the way.
Once again?
Can you confirm by mail the
next lecture? Yeah, I'll send you an invite again.
Okay, perfect. Thank you.
All right.
Have a good evening.
You too. Bye-bye.
Bye-bye.
Bye.